Let me tell you about a claim that showed up 2 years late. I will keep the details generic because I have watched this exact shape play out more than once. Imagine a small consulting firm. Back in 2023, they wrap up a project. The client seems happy. Everybody shakes hands and moves on. 2 full years go by. New office, new clients, even a new insurance policy. That old project is ancient history. Then in 2026, an envelope lands on the desk. It is a lawsuit. The client now says that old project cost them dearly and they want the firm to pay for it. So here is the question the firm is asking. They had coverage back in 2023. They have coverage now. Surely this is covered, right? And the honest answer depends almost entirely on one small word printed on the policy. Not a clause, not a paragraph, one word. That single word decides whether a claim from 2023 is the firm's problem or the insurance company's problem in 2026. Today, I am going to show you that word, both versions of it, and how to make sure you are never caught in the gap between them. The word we are hunting for is the trigger. It is how a policy decides which claims it is willing to answer for. Every liability policy has to draw a line in time. It has to decide which events belong to it and which ones do not. There are 2 main ways to draw that line, and they are wired completely differently under the hood. The first way is called occurrence. The second is called claims made. Those 2 little phrases are the whole ballgame. Same premium, same limits, the same friendly agent. But underneath, these 2 forms protect you on totally different clocks. And most owners never think to check which one they are holding, right up until the day it suddenly matters. So before we go deeper, hold on to this one idea. Occurrence follows the event. Claims made follows the report. Everything else today hangs off that single difference. Let us start with occurrence, because it is the easier one to love. An occurrence policy really cares about one thing. When did the bad thing actually happen? If the injury or the damage happened while that policy was in force, you are typically covered. It does not matter when the claim finally shows up. Here is a simple way to picture it. Imagine a customer slips in a shop in 2023, but it only turns into a lawsuit in 2026. With an occurrence policy, you look back to the year of the slip. That is the policy that responds, even though it has long since renewed or expired. The claim can arrive 2 years late, 5 years late, sometimes even longer, and it still points back to the policy that was live when the event happened. You can cancel that policy, switch carriers, even close the business, and an occurrence form generally still answers for things that happened on its watch. That is why people describe occurrence coverage as buying peace for a moment in time. You lock in that year, and that year stays protected. This is one reason so much general liability, the everyday slips, trips, and property damage coverage, is typically written on an occurrence form. The harm and the lawsuit can be years apart. And because that year stays locked in, you do not have to keep an old occurrence policy alive to stay protected. The coverage travels with the year, not with the paperwork. Now meet the other form, claims made. A claims made policy cares about a different moment entirely. Not when the event happened, but when the claim gets reported. To be covered, the claim generally has to be made against you while the policy is active, or during a special window we will get to shortly. So the clock that matters is no longer the year of the mistake. It is the year the phone rings. These policies also carry something called a retroactive date. Think of it as the earliest day the policy is willing to look back to. If the incident happened before that retroactive date, a claims-made policy typically will not cover it, even if the claim gets reported today. So claims-made really asks 2 questions, not one. Did the event happen after my retroactive date, and was the claim reported while I was switched on? You might wonder why anyone would build coverage this way. It comes down to the kind of risk being insured. Professional mistakes, bad advice, a management decision, these can stay quiet for years before anyone notices. Claims made lets an insurer see those claims as they are reported. That is why you meet claims made all over the professional lines. Errors and omissions, which is professional liability, is usually written this way. So are directors' and officers' policies, employment practices, liability, and a great deal of cyber coverage. The kinds of claims that tend to surface long after the work is done. The upside of this design is that a claims-made policy tends to price against today's known risks, rather than guessing decades into the future. That is part of why insurers reach for it in the tricky long-tail lines. Here is where a lot of business owners get tempted, and it is worth understanding why. In its early years, a claims-made policy often costs less than a comparable occurrence policy. That first-year price can look genuinely attractive. But the price usually steps up each year for roughly the first 5 years, as the policy takes on more of your history. Eventually it matures, and a mature claims-made policy tends to cost much closer to what occurrence would have cost you all along. So that cheaper sticker up front is not really a discount. It is closer to paying in step as your exposure grows. And none of this makes claims-made the bad guy. For many professional risks, it is simply the standard, and sometimes the only way coverage is offered. The real lesson is not that one form is cheaper. It is that the low first-year price quietly comes with a job, which is protecting the years sitting behind you. Now let me show you the trap, because this is where a claim from the past comes back to bite. Say you carry a claims-made policy this year. You do solid work, but at renewal you switch carriers, or you retire, or you close up shop. The old policy is now gone, and here is the catch. If a claim lands next year about work you did this year, that old policy is no longer active to receive it. The event happened on the old policy's watch, but claims-made does not care about the event. It cares about the report, and there is nothing left to report it to. This is not the insurer being sneaky. It is simply how the form is built. It only responds to claims reported while it is switched on. That is the gap. A claim can fall right between an expired claims-made policy and a brand new one that only looks forward. Come back to our consulting firm one last time. If that old policy was claims-made and it lapsed with nothing protecting late claims, that 2-year-old lawsuit could land in exactly this gap. And a brand new policy usually will not reach back to cover work you did before you bought it, unless you specifically arrange for it to. The frustrating part is that nothing went wrong with the work itself. The only thing that failed was the timing between one policy ending and the claim arriving. So how do you protect yourself? The good news is the industry already built the tools. You mostly just have to ask for them. The first tool is called tail coverage. Its formal name is an extended reporting period. A tail extends your window to report claims after a claims-made policy has ended. So a late claim about old work still has somewhere to go. When you cancel or switch a claims-made policy, buying that tail is often what closes the very gap we just walked through. Tails can be arranged for different lengths, from a single year to several years, and sometimes longer. The right length depends on how late claims tend to arrive in your line of work. The second tool works from the other direction. It is often called prior acts or nose coverage. When you start a new claims-made policy, you can frequently set the retroactive date back to when your old coverage began. That lets the new policy reach back and cover work from your earlier years, instead of only looking forward from the day you signed. Put simply, a tail protects the past when you leave a policy, and prior acts protects the past when you join one. So here are the questions worth asking. Ask your agent, is this policy occurrence or claims made? That should be a one-word answer, and a good agent will know it instantly. If it is claims made, ask what the retroactive date is and how far back it actually reaches. And ask what a tail would cost if you ever left, so a surprise from the past never turns into a surprise from your own wallet. If you are ever moving between carriers, ask both sides to line up the dates. The tail on the way out and the prior acts on the way in should meet in the middle, with no year left uncovered. So let us bring it home. One word on your policy quietly decides whose problem an old claim becomes. Occurrence locks in the year the event happened and protects it no matter when the claim shows up. Claims made protects you while the policy is live, watches that retroactive date, and leans on a tail or prior acts to guard the years around it. Neither one is the villain here. The real danger is not knowing which one you hold and getting caught in the gap between two policies. One important note before you go. This is an educational channel, not insurance advice. Policy forms and state rules vary, so please sit down with a licensed agent and check what your own policy actually says. If this made the fine print feel a little less scary, do me a favor and subscribe. Here at the coverage desk, we turn insurance jargon into plain English, one policy at a time. I am Ray. I will see you in the next one.